can only trust the stablecoin insofar as you trust its stability mechanisms. So how does Silk stabilize itself? That's what we'll dig into in this video. Silk's design actually has 5 stability mechanisms in place. Most stablecoins have 1 or 2, but because of Shade's diverse mechanisms, there's a wide range of tooling to help safely grow Silk over time with a high level of care and fine-tuning. You might be wondering, why is that necessary? Why would you need to be able to tune Silk? It's captured a little bit in the word tune if you can imagine a stringed instrument. Strings that have the perfect tension to hit the right notes, kind of like a peg, those are in tune. But that doesn't mean that that instrument stays in tune forever. You need an electrical tuner or an amazing ear to be able to get those strings back to the right tension, back to the peg if things fall out of tune. Specifically with Silk, the protocol needs to be able to tune Silk 2 ways, up or down. If Silk is trading above its peg at $1.07, then based off of the simple rules of supply and demand dynamics, we need to increase supply or decrease the demand to get Silk to move back down to that $1.05 peg. Conversely, if Silk is trading below peg at $1.03, then we would need to decrease the supply or increase the demand for Silk to elevate that trading price to $1.05. In order to be able to move Silk up or down effectively, both the protocol and the market need to be able to and incentivized to do this. And that's what these stability mechanisms are. They can tune Silk up or down. Another way of describing this is that these stability mechanisms help manage complex risk in a way that protects the value of Silk and keeps it stable. Because a stablecoin is fundamentally a liability. Silk, or any other stable, is only as good as its ability to be redeemed for its stated peg value. And these mechanisms need to be able to manage scenarios like a bank run or a total market collapse. That's why Shade Protocol has actively planned for Silk's failure and then built those strategies into these mechanisms. Silk has 5 stability mechanisms detailed in the white paper, but we'll focus on just 3 in this video. First is overcollateralized minting. Silk is minted when a user locks up, let's say, $100 worth of a volatile asset like staked atom or staked secret, and then gets back $50 worth of Silk or whatever the loan-to-value ratio allows. If the collateral value drops and the loan-to-value ratio crosses into an unsafe or unacceptable threshold, then that Silk is liquidated. And Shade has some pretty creative mechanics here that are different than typical lending protocols and also beyond the scope of this video. Again, check out the docs or the white paper to dig a layer deeper there. But suffice to say that overcollateralization is a very safe way to mint a stablecoin because you know that its value is backed by that collateral. In this mechanism, the growth of Silk supply can be controlled through multiple parameters. There are minting limits on lend for the total amount of Silk that can be minted. There are vault minting limits that limit the amount of Silk that can be minted for one particular type of collateral. All these parameters can be adjusted to, again, help tune Silk up or down, metaphorically, so that the circulation meshes with demand. Now, if overcollateralization were Silk's only stability mechanism, there would be some downsides. It's not capital efficient to lock up more value and mint less value. Not everyone would want to do that or be incentivized to do that. So it's a very slow, albeit safe, way to scale a stablecoin. Overcollateralized minting is kind of like a turtle. It only has one slow speed, but a nice protective shell. The second stability mechanism we'll take a look at here is bonds. Maybe you've already interacted with Shade bonds. This allowed the protocol to obtain some protocol-owned liquidity even before Swap and Silk launched. Bonds for Silk would look a bit different and have a distinct purpose from that, though. Basically, the protocol could buy and repurchase Silk off the market or issue Silk at a discount or a premium to help grow the Treasury or to maintain the stability of Silk peg. In other words, it's a means for Shade DAO to directly interact with the Silk market and fine-tune it, again, up or down. Let's say, for example, that Silk has been widely adopted. The supply is quite large, but it's been off peg at $1.02 for a few weeks. And for whatever reason, arbitrage hasn't brought it back to peg. One way to bring it back to $1.05 would be by reducing the circulating supply of Silk. So the DAO might say, sell us $90 worth of Silk and we'll give you $100 worth of secret wrap BTC or staked atom or staked secret. And the market, in turn, is incentivized to buy these assets at an attractive discount, which will reduce Silk's supply and then bring the peg back to where it needs to be. So that's bonds, second stability mechanism. The third mechanism we'll take a look at is bounded conversion minting, or BCM for short. BCM allows the protocol to mint or burn Silk in a very specific context with very specific and strict parameters. With Terra and UST, anyone in the world could mint liabilities. That is, they could burn Luna to mint UST. This was their supply creation mechanism, which was at the heart open liability issuance. Anyone can mint liabilities. And this approach turned their supply absorption mechanism into an enormous attack vector. The risk was equity depreciation post-liability issuance, or EDPLI. This is detailed more in the white paper and in the docs, but what happens if Luna takes a massive dip and the value of the stablecoin UST outpaces the value of the equity used to mint it? It should have been a huge danger signal when UST's market cap surpassed Luna. Shade makes some very needed improvements on this. Number one, with bounded conversion minting, Shade Protocol resolves the risks of the open liability issuance assumption by making it such that only the protocol itself is capable of issuing liabilities against equity and redeeming liabilities against equity. So, in other words, only Shade Protocol, under a very specific set of parameters, strict circumstances, the protocol could burn Shade to mint Silk or burn Silk for Shade. Shade has created vastly safer boundaries for this very tame algorithmic expansion for supply creation and supply absorption. Because with Terra, seigniorage was the only mechanic to expand or contract the supply of the stablecoin, the protocol was entirely reliant on users interacting with these contracts in a non-malicious way. Because Shade Protocol has the other stability mechanisms we've talked about in place, in these issuance mechanics, the reliance on permissionless participation in the supply creation mechanism, all that is sidestepped. So here's the basic idea, TLDR. If the supply creation mechanism of the stablecoin can be properly bounded, in other words, if we can responsibly do some algorithmic minting, it would stand to reason that the supply absorption mechanism will then consistently perform its intended role. And if you get these boundaries right, Silk could actually be more stable as a result of BCM. So then here's the most important question we should all be asking. What are the rules of how BCM works? This is detailed very clearly in the white paper, which if you've made it this far, you're enough of a learner, you probably want to go check that out yourself, dig in deep there. But here's the conclusion that the research team arrived at after crunching the numbers, doing all the math related to this. Because Silk is over-collateralized, it is possible for some algorithmically backed Silk to exist in circulation and for the system to remain solvent, even in a catastrophic economic scenario. So here are the basic rules for bounded conversion minting. The protocol can only use BCM within the context of the following. First, system-wide debt. So they're taking into consideration the total amount of collateral that is locked up backing Silk. What is the total value of collateral against it right now? Second, takes into consideration this risk of equity depreciation post-liability issuance, or EDPLI. This is what Shade calls the EDPLI Treasury risk management model, which requires 200% asset backing per Silk minted from the Treasury. So there would have to be double the Treasury value of any type of Silk that we're going to mint. Third, Silk minted via BCM can only be used within the context of arbitrage and staking applications. So we're keeping that Silk very close to the chest and making sure that it doesn't contribute to further risk in the system. It's helping either A, with arbitrage, tune the peg of Silk up or down, or it's being staked. Well, how much BCM Silk is too much in the system? Again, we need to responsibly do the math on all that, which is what the white paper is, but essentially Shade will calculate the total collateralization ratio for Silk and then ensure that any BCM Silk keeps that collateralization ratio in an acceptable range, well above 100%. In the white paper, the model is 110% in the example that they're giving. BCM is another tuning tool that allows the protocol to adjust Silk supply up or down to ensure that Silk is utterly stable. We've mentioned that there are 5 stability mechanisms that exist in theory around Silk and are ready to go into play, but we've only touched 3 here in this video. Yet, as you can see, Silk has exactly what you would want from a next generation stablecoin. Multiple points of stability. There's not just one tool in the toolbox, but a variety of mechanisms that can be used to adjust Silk supply, growth, and peg stability. Not only is Silk the world's first private basket peg stablecoin, but it's fortunate enough to be born at a time to learn from past failures, past successes, and to iterate on those stablecoin playbooks. That puts Silk in a very favorable position moving into the future. If you want to learn more, visit the docs at docs.shadeprotocol.io, where you can also see the Silk white paper. And make sure to follow Shade Protocol on socials for the latest content and announcements to stay up to speed.